When the stock market crashes, most people lose everything. Their savings vanish, their dreams crumble, and their futures disappear into dust. But there's another side to this story that Wall Street doesn't want you to hear. While millions of ordinary investors get wiped out, a small group of elite traders walk away with billions. They don't just survive the crash, they orchestrate their wealth around it. This isn't luck. This isn't insider trading. This is a pattern that has repeated for nearly a century, and it's about to happen again. In 1929, while America watched its fortunes evaporate during Black Tuesday, one man made $100 million in a single day. In 2008, as banks collapsed and homeowners faced foreclosure, another investor pocketed $4 billion by betting against the very system everyone else trusted. These weren't accidents. These weren't flukes. These were calculated moves by individuals who understood something the masses never will. That crashes don't destroy wealth, they transfer it, from the many who believed the lies to the few who saw the truth coming. Today, we're standing at the edge of another precipice. The signs are everywhere if you know how to read them. Excessive leverage, speculative bubbles, and that familiar sense of invincibility that always precedes disaster. The same patterns that created fortunes in 1929 and 2008 are forming again. And the investors who recognize these patterns aren't just preparing to survive the next crash. They're positioning themselves to profit from it on a scale that will make previous fortunes look modest. The crash profit pattern isn't taught in business schools. It isn't discussed at investment seminars, because revealing it would expose the uncomfortable truth about how financial markets really work. That behind every great crash lies a great transfer of wealth. That the system isn't broken when it collapses. It's working exactly as designed. And those who understand this design don't fear crashes. They wait for them. Let's start with the foundation of the pattern. Every great crash begins the same way, with a period of unprecedented optimism where everyone believes they've discovered the secret to endless wealth. In the 1920s, it was stocks that could only go up. In the 2000s, it was houses that could never lose value. Today, it's artificial intelligence, cryptocurrency, and a dozen other bubbles inflating simultaneously. The specific asset doesn't matter. What matters is the psychology. When ordinary people start borrowing money to buy investments, when taxi drivers give stock tips, when everyone believes this time is different, that's when the smart money starts preparing for the opposite. The crash profit pattern has three distinct phases. First comes the recognition phase, where contrarian investors identify the bubble before it bursts. This requires seeing through the euphoria and analyzing the fundamentals that everyone else ignores. Second is the positioning phase, where they structure trades designed to profit massively from the inevitable collapse. This demands courage because they're betting against consensus while everyone calls them crazy. Third is the execution phase, where they maintain their positions through volatility and pressure until the crash validates their analysis and delivers extraordinary returns. But here's what makes this pattern so powerful and so dangerous. The same psychological and structural forces that create crashes also create the opportunities to profit from them. Excessive optimism leads to mispriced assets. Leverage amplifies both the bubble and the collapse, and the herd mentality that drives prices to unsustainable levels also ensures that most investors will be on the wrong side when reality strikes. The first master of this pattern was Jesse Livermore, a trader who understood that markets move in cycles and that human nature never changes. Born in 1877, Livermore began trading at 14 and spent his life studying the psychology of speculation. While others focused on company earnings or economic reports, Livermore watched how people behaved when money was on the line. He saw that greed and fear drove markets far more than logic or fundamentals, and he built his fortune by positioning himself opposite to the crowd when their emotions reached extremes. By the late 1920s, Livermore watched as America fell in love with the stock market. The Dow Jones had increased tenfold over 9 years, reaching 381 in September 1929. Everyone was buying stocks. Barbers, taxi drivers, shoeshine boys. People were borrowing money to buy more stocks, with brokers lending over $8.5 billion by August 1929. That was more than all the currency circulating in the United States at the time. The average margin requirement was just 50%, meaning investors could control twice as much stock as they actually owned. When prices rose, they made double profits, but when prices fell, they faced double losses. Livermore saw what others missed, that the market had become disconnected from economic reality. That speculation had replaced investment, that the entire system was built on borrowed money and borrowed time. While everyone else celebrated endless prosperity, Livermore began building massive short positions. He was betting that the party would end, and when it did, he would profit from every dollar that vanished. From his command center on the 18th floor of a Fifth Avenue building, Livermore watched the market with the patience of a predator. He understood that timing was everything. Enter too early, and margin calls could destroy him before he was proven right. Enter too late, and the opportunity would disappear. He waited for the perfect moment when the cracks in the system would finally split open. That moment came on October 29th, 1929. Black Tuesday, the most devastating day in stock market history. Within the first 30 minutes, 3.5 million shares had been sold, and $2 billion of wealth had vanished. The market had become a disaster machine, feeding on its own panic, as forced selling triggered more forced selling. While millions of Americans watched their life savings disappear, Livermore's short positions generated profits beyond imagination. His success wasn't just about predicting the crash. It was about understanding the mechanics of how crashes unfold. That once panic selling begins, it becomes self-sustaining. That margin calls force investors to sell at the worst possible prices. That fear spreads faster than any rational analysis. Livermore didn't just bet against overvalued stocks. He bet against human psychology itself, and psychology paid him $100 million, equivalent to nearly $1.5 billion today. But Livermore's triumph reveals something crucial about the crash profit pattern. It's not enough to be right about the direction. You have to be right about the magnitude and the timing. Many investors saw trouble coming in 1929, but only a few positioned themselves to capitalize on the full scope of the collapse. The difference between those who made modest profits and those who made fortunes was their willingness to bet big when the evidence supported extreme outcomes. The pattern didn't disappear after 1929. It went dormant, waiting for the right conditions to emerge again. Those conditions require excessive leverage, widespread speculation, and institutional failures that create systemic risks. It took nearly 80 years, but by the mid-2000s, all the pieces were falling into place for another massive transfer of wealth. The housing bubble of the 2000s created opportunities that dwarfed even the stock market crash of 1929. This time, the speculation wasn't just in stocks, it was in the very foundations of American life. Homes, mortgages. The dream of home ownership had been weaponized into a financial instrument that would destroy the global economy. And once again, a small group of investors saw through the illusion and positioned themselves to profit from the inevitable collapse. The crash profit pattern was about to prove that it wasn't just a relic of the past. It was a timeless feature of financial markets, and the investors who understood this were preparing to make the fortunes of 1929 look small by comparison. The housing boom of the early 2000s looked unstoppable. Home prices had been rising for years, and the financial industry had convinced itself that real estate was the safest investment on earth. Banks packaged mortgages into complex securities, rating agencies stamped them with AAA ratings, and investors around the world bought them without question. The system seemed foolproof. Houses were local, tangible, and necessary. Unlike stocks, people argued, real estate couldn't just disappear. But beneath this confidence lay the same dangerous assumptions that had destroyed fortunes in every previous bubble. John Paulson saw what others refused to see. A hedge fund manager running a relatively modest $6 billion in assets, Paulson had spent years studying market cycles and financial crises. While his peers chased the latest trends, he focused on finding situations where prices had become divorced from reality. And by 2005, he was convinced that housing represented the largest mispricing in financial history. The mathematics was staggering. Housing prices had appreciated far beyond what incomes could support. Mortgage lending standards had collapsed to the point where borrowers needed no documentation, no down payment, and sometimes no job. Subprime mortgages with teaser rates were being packaged into securities and sold as safe investments. The entire system was built on the assumption that housing prices could never fall nationwide. It was 1929 all over again, but this time the bubble encompassed the global financial system. Paulson's challenge was different from Livermore's. You can't short a house the way you can short a stock. Instead, he had to find financial instruments that would profit from mortgage defaults and housing price declines. The solution came in the form of credit default swaps, essentially insurance contracts that paid out when underlying securities failed. These instruments were cheap because everyone believed the underlying mortgages were safe. Paulson began buying them in massive quantities. What separated Paulson from other pessimistic investors was his understanding of how the housing collapse would unfold. He didn't just bet against subprime mortgages, he studied the entire securitization chain, identifying which securities would fail first and which would create cascading failures throughout the system. He realized that the rating agencies had fundamentally misunderstood the risks, treating diversified pools of bad mortgages as if diversification could eliminate the underlying problems. The genius of Paulson's strategy was its asymmetric risk profile. His maximum loss was limited to the premiums he paid for the credit default swaps, but his potential profits were theoretically unlimited as the housing market collapsed. When subprime mortgages began defaulting in large numbers, the securities backed by these mortgages would become worthless, and Paulson would collect the full face value of his insurance contracts. As housing prices peaked in 2006 and early signs of trouble appeared, Paulson faced the same psychological pressures that had tested Livermore decades earlier. His investors questioned his strategy. Other hedge fund managers mocked his bearish outlook. The financial media dismissed his warnings as doomsday speculation, but Paulson held firm, adding to his positions as evidence mounted that the housing market was beginning to crack. The collapse began slowly, then accelerated with terrifying speed. Subprime lenders started failing in 2007. Bear Stearns hedge funds collapsed. Northern Rock required emergency support from the Bank of England. Each new crisis validated Paulson's analysis and multiplied his profits. By the end of 2007, his firm had made $15 billion. His personal share was nearly $4 billion, more than $10 million per day. But Paulson's success revealed something even more important about the crash profit pattern. The scale of modern financial markets meant that the potential profits from crashes had grown exponentially. Where Livermore made hundreds of millions, Paulson made billions. The leverage and interconnectedness that made the system more fragile also made the opportunities for those who positioned correctly vastly larger. The third master of the crash profit pattern took a different approach entirely. Michael Burry was a former physician who had started a small hedge fund called Scion Capital. Unlike the flamboyant Livermore or the sophisticated Paulson, Burry was an obsessive researcher who spent his time reading financial documents that others ignored. He didn't rely on market psychology or complex trading strategies. He simply read the fine print until he understood what others had missed. Burry's analysis of the mortgage market was forensic in its detail. He obtained and read the actual mortgage documents underlying various securities, discovering that lending standards were even worse than the market realized. Loans had been made to people who couldn't possibly repay them. Documentation was fraudulent or non-existent. The entire mortgage industrial complex was producing toxic waste and packaging it as investment-grade securities. What made Burry's approach particularly powerful was his willingness to act on his convictions despite overwhelming opposition. His investors demanded explanations for his bearish positions. They threatened to withdraw their money. Some questioned his sanity, but Burry refused to back down, even placing restrictions on withdrawals to prevent his investors from forcing him to abandon his strategy at the worst possible moment. When the housing market finally collapsed, Burry's patience was rewarded. His fund generated returns of nearly 500%. He had turned $100 million into over $700 million for his investors, while earning substantial profits for himself. More importantly, he had validated the power of independent research and contrarian thinking in identifying systemic risks that the entire financial establishment had missed. The success of Livermore, Paulson, and Burry wasn't just about their individual brilliance. It was about their understanding of a fundamental truth about financial markets, that crowds are consistently wrong at extremes, that institutions designed to prevent crashes often enable them. That complexity creates opportunities for those willing to do the work to understand what others cannot or will not see. Each crash profit master had developed his own approach, but all shared certain characteristics. They maintained intellectual independence when consensus was overwhelming. They had the courage to act on unpopular views when evidence supported them. They understood position sizing and risk management well enough to survive being wrong in the short term. And they possessed the emotional discipline to hold contrarian positions through periods of intense pressure and criticism. The crash profit pattern also reveals something uncomfortable about the nature of financial markets themselves. They are not efficient mechanisms for allocating capital. They are not rational systems that reflect economic fundamentals. They are psychological battlegrounds where fear and greed create opportunities for those who understand human nature better than others do. The crashes don't happen because markets fail. They happen because markets work exactly as human psychology dictates they must. This understanding explains why the pattern keeps repeating. Human nature doesn't change. Greed still drives people to take excessive risks when times are good. Fear still causes panic selling when trouble appears. Leverage still amplifies both the booms and the busts. And the regulatory responses to previous crashes often create new vulnerabilities that enable different kinds of speculation and excess. The instruments and markets change, but the underlying dynamics remain constant. The crash profit pattern adapts to whatever form speculation takes. In 1929, it was direct stock speculation. In 2008, it was mortgage securitization. The next crash will likely involve different assets and different instruments, but the same psychological and structural forces will create similar opportunities for those who recognize them. What makes the current environment particularly dangerous is the scale and complexity of modern financial markets. Central bank policies have created asset bubbles across multiple sectors simultaneously. Artificial intelligence stocks trade at valuations that make the dot-com bubble look conservative. Cryptocurrency markets swing wildly based on social media posts and celebrity endorsements. Private equity has inflated the prices of everything from software companies to nursing homes. The everything bubble has created conditions where multiple crashes could cascade through the system simultaneously. The warning signs are everywhere, but they're hidden in plain sight. Michael Burry, the same investor who profited from the 2008 housing collapse, is once again betting against the market. This time, his targets include artificial intelligence, darling Nvidia, and Chinese tech giant Baidu. Goldman Sachs CEO David Solomon recently warned that much of the capital being deployed in AI will produce no returns. Both Goldman Sachs and Morgan Stanley have issued warnings about potential market corrections, with Goldman forecasting a possible 10 to 20% drawdown in the next 12 to 24 months. But these aren't just random predictions. They're the early tremors of a pattern that has played out before. The crash profit masters understand something that escapes ordinary investors. They know that markets don't crash randomly. They crash when structural imbalances become so extreme that they cannot be sustained, and those imbalances are building again faster and larger than ever before. The modern crash profit pattern is emerging in multiple asset classes simultaneously. Central banks have pumped trillions of dollars into financial markets, creating what economists call the everything bubble. Stock valuations have reached levels that make previous peaks look modest. Real estate prices have soared beyond what incomes can support in markets around the world. Corporate debt has exploded to record levels while interest rates remained artificially low. Cryptocurrency markets have created and destroyed fortunes based on nothing more than social media hype and celebrity endorsements. Each of these bubbles alone would create opportunities for crash profiteers, but their simultaneous existence creates the potential for cascading failures that could dwarf previous crashes. When one bubble bursts, it could trigger margin calls and forced selling that spreads to other, overvalued assets. The interconnectedness that has made markets more efficient has also made them more fragile. A crisis in one sector can now destroy wealth across the entire financial system in a matter of hours. The sophistication of modern financial instruments has also evolved the crash profit pattern. Where Livermore relied on direct short selling and Paulson used credit default swaps, today's crash profiteers have access to options, inverse ETFs, volatility products, and synthetic instruments that can amplify returns from market declines. These tools allow for more precise targeting of specific risks and potentially unlimited profits when major dislocations occur. But the increased complexity also creates new challenges. Modern markets are dominated by algorithmic trading systems that can amplify volatility in ways that human traders never could. High-frequency trading can turn small price movements into massive swings within seconds. Passive investing through index funds has concentrated ownership of entire sectors in the hands of a few large firms. When these systems break down, they could create crashes that unfold faster and more violently than anything seen in previous generations. The regulatory environment has also created new vulnerabilities while attempting to address old ones. The Dodd-Frank Act and Basel III regulations were designed to prevent another 2008-style crisis, but they've pushed risk-taking into new areas that regulators don't fully understand. Shadow banking has grown to enormous proportions outside traditional oversight. Derivatives markets have become even more complex and interconnected. Central bank policies have created moral hazard where investors take excessive risks because they believe authorities will always intervene to prevent major losses. These regulatory gaps and institutional blind spots are essential components of the modern crash profit pattern. They create the market inefficiencies and mispricings that astute investors can exploit. The pattern suggests that future crashes will emerge from these new vulnerabilities, offering opportunities for those who can identify them before they become obvious to everyone else. The psychological elements of the pattern remain unchanged despite technological advances. Investors still succumb to the same cognitive biases that have driven bubbles and crashes for centuries. They still mistake rising prices for validation of their investment thesis. They still use leverage to amplify returns when times are good. They still panic and sell at the worst possible moments when markets turn against them. What has changed is the speed and scale at which these psychological forces operate. Social media can spread market euphoria or panic around the world in minutes. Retail investors can access sophisticated trading tools that were once available only to professionals. Margin debt can be obtained with a few clicks on a smartphone app. The democratization of trading has accelerated the boom-bust cycle while creating larger pools of inexperienced investors who are vulnerable to manipulation by those who understand the pattern. The crash profit pattern is also evolving to incorporate new forms of speculation that didn't exist in previous generations. Special Purpose Acquisition Companies, or SPACs, have become vehicles for bringing speculative investments to public markets with minimal due diligence. Non-fungible tokens and other digital assets have created entirely new categories of speculative excess. Meme stocks can be manipulated by coordinated social media campaigns that bypass traditional market mechanisms entirely. Each of these innovations creates new opportunities for crash profiteers who understand how to position themselves against speculative excess. The specific instruments may be different, but the underlying dynamics remain the same. When speculation reaches extremes, contrarian investors who bet against the crowd can generate extraordinary returns when reality inevitably reasserts itself. The timing of the next crash remains uncertain, but the conditions for one are clearly developing. Asset prices across multiple sectors have reached levels that require perfect conditions to be sustained. Any shock to the system, whether from geopolitical events, policy mistakes, or simple recognition that valuations have become unsustainable, could trigger the kind of cascading collapse that creates fortunes for those positioned to profit from it. The crash profit masters of the future will likely combine elements from all previous generations. They will need Livermore's understanding of market psychology and timing. They will need Paulson's sophisticated analysis of complex financial instruments. They will need Burry's obsessive attention to detail and willingness to act on contrarian views despite overwhelming opposition. But they will also need to adapt these approaches to new markets, new instruments, and new forms of speculation that previous generations never encountered. The pattern is forming again, larger and more complex than ever before. The question is not whether another crash will come, but who will be positioned to profit from the massive transfer of wealth that always follows. Those who understand the pattern are already preparing. They're studying the vulnerabilities, building their positions, and waiting for the moment when consensus finally cracks and reality floods back into markets that have forgotten what risk really means. Racks. And reality have forgotten markets that what floods back into means. Risk really. The crash profit pattern isn't just history repeating, it's human nature expressing itself through different instruments across different generations. From Livermore's short positions in 1929 to Paulson's credit default swaps in 2008, the surface mechanics change, but the core remains identical. Excessive optimism creates mispriced assets. Leverage amplifies both the rise and the fall, and the crowd is always, without exception, positioned on the wrong side when the music stops. Today's everything bubble represents the most dangerous iteration of this pattern yet seen. Multiple asset classes inflated simultaneously by central bank policies that have distorted every corner of the financial system. The potential for cascading failures across interconnected markets means the next crash won't just transfer wealth. It will transfer wealth on a scale that makes previous fortunes look like pocket change. The masters of this pattern are already moving. They're not waiting for confirmation from financial media or validation from their peers. They're building positions while everyone else celebrates endless prosperity, just as their predecessors did in 1929 and 2008, because they understand what the crowd never learns. That crashes don't destroy wealth. They reveal who was swimming naked when the tide goes out. The pattern is forming again. The only question is whether you'll recognize it before it's too late. History doesn't repeat, but if you ignore its warnings, it will crush you all the same.